Good afternoon, everyone. My name is Andrew Griggs and I'm Senior Partner at Kreston Reeves. We're a professional services firm with an extensive range of services to help clients. We advise dynamic businesses, not-for-profit organisations and individuals' families on all areas of business, tax and wealth. We've been very much open for business with offices in London, Kent and Sussex, which have actually all been physically open for some time now, and we have our international reach via Kreston International. From my own perspective, I advise large and high growth entrepreneurial companies, both nationally and internationally, and I have a passion for growth as well as understanding business life cycles from creation to exit. I'm delighted today to be joined by 4 colleagues who are all bravely looking ahead, and not just to the next few months, but the next 3 to 5 years. Powell, Emma Chesson, Jack Clipsham and Andy Wallis. This is the 4th of our 6 Looking Ahead webinar series, the aims of which are twofold. Firstly, to keep businesses in the current circumstances, whilst at the same time reminding them of the need to plan ahead and think about what the future may look like. And secondly, to provide some practical tips and advice to how you might achieve a brighter future. Firstly, Caitlin from our Restructuring and Transformation team will talk about rebuilding, reviving and stabilising your finances. Emma Chesson will follow, talking about funding, including some of the non-traditional and innovative areas we're seeing developing. Jack Clipsham will follow, covering corporate finance from a private equity perspective and the opportunities that are available to businesses there. And finally, Andy Wallis will talk about trading internationally as well as international opportunities. As always, there's a little bit of housekeeping. So if I could just talk you through that. This webinar is actually being recorded and you will receive an email later today with the recording attached for future reference. Please do pose questions throughout this webinar and they will be anonymous. At the end of the 4 speakers, there will be a Q&A session with all 4 panelists taking part. So hopefully we'll get some good interaction there. And also we'd welcome your completion of the short feedback survey that will be sent with the recording of the slides to help us guide future content and ask any additional questions that you may have. And also, I'd just like to say thank you to everyone who took part in the survey. This has been very useful, and I will leave each of the panelists to pick up particular points raised from that during their presentations and discussions. And with today's theme focusing on looking forward beyond the next few months and with an international perspective, I think this is very positive and healthy. Many of you remember back to 2008-9 and the financial crash, which raised questions over the impact of a globalised economy. There's been increased nationalism and inward-looking politics around the world, America, China, and even England. Governments have pumped vast sums of money into domestic economies around the world. Some say support cannot continue, whilst others who subscribe to the world running on a modern monetary theory would not worry about debt building up in our various countries. Manufacturing and service companies may respond differently over the next 3 to 5 years. Manufacturing tasks, as opposed to whole production cycles, may be offshored overseas, whereas for the service sector, where people and offices are a large cost, the solutions may be different. A globalised economy has seen some of the poorest nations and people lifted out of poverty, and businesses that combine purpose with profit in equal measures will drive the global agenda. Emma. Caitlin, I do apologise. Caitlin, you're coming first.
I am indeed. Thanks, Andrew. Hi, everyone. Thank you for being with us today. As Andrew said, I'm Caitlin Powell, and I'm a member of the restructuring team here at Kreston Reeves. And today I'll be looking at how to rebuild, revive, and stabilise your business's finances now that restrictions have eased. So it might sound a bit dry, but as part of rebuilding from the effects of COVID-19, it's really important that you know your business. And I mean really know your business. Know what it's doing, know where it's at now, and how it's working with the new pressures that are being put on it. Whilst it may still be functioning in many of the same ways as before, Try to get rid of any preconceptions and all perspectives in your mind and make sure that you're dealing with the business as it currently stands, not how it was in February or how you hoped it might have been when you put together your P&L forecast at the start of the year. Doesn't that seem like a long time ago? Accurate and effective management information is an important part of this, as is having a cash flow that shows you where your pressure points are. It's an old saying, but a classic, and probably more relevant now than it's almost ever been, but cash really is king at the moment. Make sure that you're across where your cash position is and you're aware when cash points might be coming so you can plan for these accordingly. Cash flows don't have to be huge complex monsters that cover up every penny and pound. They can be as detailed or as not detailed as you need them to be. Just make sure they're telling you what you need to know and when you need to know it. The same applies for any revenue models that you may have. Whilst you may have these cemented in your mind, until you see them on paper, it can at times be difficult to know where your business is actually at and to be able to see that cliff edge if or when it is coming. As such, it's an exercise that tends to be worth doing. On a positive note, based on the survey results that we've had come through, where it has been done, it's generally shown that businesses to have travelled through lockdown with better results than what were initially expected from their revised forecast models. Another way to reduce this pressure, as probably also just good practice in general, is to build up your cash reserves where you can. If you've got a war chest that can see you through, then external pressures facing your customers or suppliers may be able to be more effectively managed, as those pressures will almost inevitably turn into pressures on you in terms of when they're paying or expecting payment from you. Most of you will have already done this, but even so, have a look over your costs, identify where your cash drains are, and see what efficiencies can be made. Quite an effective tip that several of our clients are using to keep an eye on the health of their business, without spending lots of time on it each week, is to highlight just 2 or 3 aspects that you consider to be the most representative measures of how your business is performing, or review those on a fortnightly or even weekly basis as a kind of barometer for the wider business performance. Almost every business will have these, and whether that's sales from takeaways or the amount that you're spending on locums or even desert days, as mentioned before, review these regularly to see how the business is travelling and make adjustments as you're going along if you see these measures increase or decrease beyond the point that you're comfortable with. What measures are used will be personal to each business or even to each director, so it's important to focus on the ones that work best for you. If you're worried about meeting your own liabilities on time, then open communication lines early and often. Be transparent and open with where you're at with suppliers or the bank. Having said that, that doesn't necessarily mean having to tell them absolutely everything. And try and avoid making promises that you can't keep. When it comes to creditor leniency and support, the importance of trust cannot be emphasised enough. If you've repeatedly missed deadlines that you said you could make, pretty soon all goodwill is going to evaporate, and suddenly you might find yourself put on either tighter credit limits or even on pro forma. Or if you really get down to it, facing a winding up petition once they're allowed again, which, trust me, really does make everything that much harder to deal with. Along with this, having a look at what funding facilities might be available to see you through. Can be worthwhile. Invoice discounting and factoring lines can be just what a business needs to manage its cash flow more effectively over the medium to long term. First, and most important, Sorry, I'm having issues with my webcam okay? So have a chat to an advisor about whether this or something else might work for you. Also have a look to see what grants and local authority loans are available. While the UK government's help is coming to an end, other sources of funding are available and might be worthwhile having a look at. Most local authorities will have grants up on their website, but also touch base with your trade body if you have one, and places like Coaster Capital, Innovate UK, and even Facebook to see what's around currently. Once your business is feeling a bit more even keel, and the worst of the short-term crisis is looking like it's over, it's important to consolidate those gains and ensure that your business finances are looking stable over the medium to long term. First, and most important, make sure that you match your costs to your revenue. Keep in mind all the additional funding and repayment holidays that your business has benefited from, and ensure that you've got the cash available or appropriate repayment options are in place for when these fall due. Think ahead and anticipate how you will make the CBILS repayments. Ensure that you're provided for VAT, business rates, and other taxes and payments that will be coming back into play in the near future. As noted earlier, cash is king, and so ensure that your war chest is as brimming as it can be. Make cuts if you need to. As harsh as they can seem at the time, your business and its employees will benefit long-term from it being as lean as it can be, especially when revenue may be variable over the upcoming medium to long term. Again, here a cash flow, however basic, is invaluable in determining when those cash crunch points will be. Use it to plan accordingly and make sure that you aren't caught out. Speaking of variables, make sure that you've considered and noted down all your learnings from the first wave of the virus. Have a bit of a debrief and note down what you do differently in the event of a dreaded second spike. Consider how you'd respond to a new wave of restrictions and think about what risk mitigation strategies you can implement now to ensure that any fall in revenue brought about by a new lockdown is cushioned appropriately. If you haven't already, put a pandemic action plan into place and ensure that your emergency and crisis management plans are fully updated. And so, reviving. Once you're happy that you've managed to rebuild from the impacts of coronavirus and you're feeling pretty stable, it's time to consider how best to revive your business. This is going to look different for every business out there, even those in the same sector or marketplace. Depending on where your business is at, and all that solid, accurate management information that I talked about earlier is going to be invaluable here for working that out. It might be time to consider different growth opportunities. These might include investment if you want to expand a bit more, but would like some extra backing behind you to do that. Here you can look at different private equity options or consider if the crowdfunding route is something that might appeal to you. Again, seeking advice from a professional here will likely be invaluable, as there are a wealth of different players in this field, and not all of them are created equal or be the right fit for your business. An advisor can assist with seeking this investment, making sure you aren't wasting your time with those that wouldn't be the right fit, making sure that you're presenting your business in the best and the right light for success. Having the right information in the right format could often help to make finding funding an infinitely less painful experience. Our Head of Corporate Finance, Jack Clipsham, will be expanding on this further in the webinar, so I won't cover it in any more detail here. If you aren't keen on that route and would prefer extra cash to invest in your business on a smaller scale and without the associated strings that come from private investment, then debt funding may be a better move. There are lots of different loan packages and facilities out there, so take some time to work through what it is that your business actually needs and would most benefit from. My colleague Emma Chesson will be expanding on this in more detail next. I will say though, that if you are thinking about this, it is worthwhile having a look at what your local authority is offering. Kent County Council, for example, has a business fund which runs rounds throughout the year to offer zero interest loans to eligible businesses to help them to grow. Other options for revival include diversifying your business model and approaching competitors or complementary businesses to see if there are options to collaborate and expand together. Local business hubs may assist with this and could help to put you in touch with other businesses who may be looking to do the same thing and have a similar approach and mindset. Finally, there's always the option, if you've got the funds to do it, to acquire another business and expand that way. Now is an interesting time to be looking at that, and care does need to be taken to ensure that the businesses you're looking at are performing and will continue to perform the way that you would like them to. Assure that any due diligence you undertake is as thorough as it can possibly be, and take some time to work through how best to integrate them in your current model to make sure that they're the right fit for you and it's the right time. But for now, unless there's any questions, I'll leave that here and pass on to Emma Chesson, our Head of Online Services, who's going to talk us through funding and debt funding.
Right, thank you, Caitlin. That was really helpful. So as Caitlin said, I'm Emma Chesson. I'm part of the funding team here at Kreston Reeves. I'm also part of a growth team that we run here, where we work closely with our clients to help them with their business growth strategies. So I'm going to be talking through the current lending landscape, and our view of what the funding market might look like once the government schemes have ended. So unless you've been living under a rock, you probably know that there's something called the Bounce Back Loan and the Coronavirus Business Interruption Loan Scheme, which for the rest of the webinar I'll be calling CBILS because it's a lot easier to say. These are both coming to an end very shortly. With the Bounce Back Loan, you've got until the 4th of November to get your applications in. The approval rate for these loans is slightly higher than on the CBILS. You're looking at around an 80% approval rate at the moment. This is generally deemed as a quick cash flow injection of loans of up to £50,000. These are self-certified and there's no credit checks involved. The CBILS is a great opportunity to secure unsecured facilities of up to £250,000. The maximum you can go for is 5 million, but anything over 250, you're looking at probably needing a personal guarantee. The approval rates for CBILS is around 50%, so it's quite a bit less than the bounce back. So there were some mixed messages going around with some banks giving different deadlines for applications and things. But since then, we've had the government extension. So just to clear up some of that for you, we've got the application deadline, which is the end of September. So you've got until the end of next month to get those applications in. And then that is for payout by the end of November. One thing that some people aren't aware is that you're able to go for invoice and asset finance via the CBILS route, obviously through a CBILS approved lender, and you can actually have more than one CBILS loan. So, but you just can't mix and match the bounce back and the CBILS. So an example here is we had a client that needed 2 new work vans and already had a CBILS loan via his bank, and he managed to get secure funding through a CBILS approved asset finance company to get a second one, a loan through for the asset finance. So the point to note here is that you can have you can have more than one CBILS, but you just can't breach the 5 million limit here. So generally a good rule of thumb on what you are able to be loaned is around 25% of turnover. That's generally what we're seeing, and it's normally based on sort of prior year accounts. So CBILS, while CBILS is still available, it's a good opportunity to look at your working capital and how that's how the mix works on that. So the good thing on CBILS is you have no repayments in the first year, so that is obviously good for the cash flow, and it's usually unsecured. I think the average CBILS loan that via the stats is around 240, which is conveniently just under the 250 where you might need security. The rates we're seeing, it's generally it's a cheaper option. So the rates we're seeing at the moment are between about 2.4 to 6% above base. So it's quite an attractive rate there. But that's on loans and not on invoice or asset finance. So wider than the government schemes then, what we're also starting to see in the market is businesses starting to take a step back and look at their wider assets and look at other funding options. There's more structured and secured management buyouts, for example, where business owners are reflecting upon their exit strategy plans. There's some more property-based lending, so we're starting to see a few more bridging loans as property loans reach their expiry dates. This typically is an expensive option, so it's not something that we would necessarily recommend as a long-term solution, but these can work quite nicely for short-term fixes. Also, there's more commercial mortgages that we're starting to see as landlords are starting to offload some assets there. So looking through the results of the survey that you completed prior to this webinar, it looks as though a third of you roughly that are watching this are anticipating potentially needing funding in the next few months. So what does the future look like? Well, with our crystal ball, we think that, in our view, that the lending landscape, once the government schemes have ended, is going to look pretty uncertain, certainly in Q1 next year. I think what is very likely is that there's going to be a lot more personal guarantees requested on funding applications, and also secured facilities being offered. So generally, I think if you're looking at funding possibly needing funding in the next 12 months, generally recommendation is to apply while the government schemes are still open, because this can act as a buffer for you, because there is a lot of flexibility with the CBILS. You can refinance or reduce or repay a CBILS without any penalty or any additional interest, certainly in that first year. So it is something that can be used as a buffer if you feel like you might need it. But that being said, don't give up your CBILS lightly, because as I've mentioned, they are very attractive interest rates that you're probably unlikely to be able to secure potentially next year, and they are generally effectively unsecured. However, banks do still want to lend to viable, profitable enterprises, and they're much better capitalised now. We recommend going to your own lender first, because at the height of COVID, a lot of banks were closed to new business and were prioritising their own clients, but we're starting to see lenders starting to open up their books to some new business. So in terms of other options, then don't forget that there's the fintech algorithm lending option. So that's things like Funding Circle, iWalker, Esme. These are usually a little bit more expensive, and they're normally computer says yes or no type affairs. There's no negotiation to be had, but they are quite speedy in their delivery. So that's an advantage. And we also do have a whole team here at Kreston Reeves that are accredited and have access to over 100 lenders via an online lending platform, and would be happy to assist in your search for funding. We've helped lots of clients negotiate loans all the way up to sort of 7 million. So we've got quite a wide range of experience here. And then lastly, businesses could look to private equity funding to develop their business. But I'll let Jack take over from there and not steal his thunder. So over to you, Jack.
Thanks, Emma. I just got to turn that on. There you go. Emma, thank you for that, and good afternoon, everyone. As with the banks, private equity firms and family offices as well reacted very swiftly to the lockdown. Almost immediately, live deals were put on hold, and they stopped looking at new deals pretty much completely. Understandably, they were focusing on existing portfolio companies, making sure that they were financially sound and had the funding necessary to see them through the initial and longer term impacts of COVID. But as the government support was introduced, businesses realigned, restructured, and were coming to grips with the new environment, ensuring the necessary funding was in place, short term at least. Private equity firms have relaxed a bit. They've restarted what were mothballed deals, and they've definitely begun to look once again at new opportunities. I'm certainly not suggesting that everything is now okay, and personally believe that we are set for a very uncomfortable ride over the next 6 months at least. Unfortunately, some businesses are going to fail, and certain sectors are going to be hit much harder than others. The trade association UK Hospitality only last week issued a report having questioned the leaders of 140 of their members that collectively run 12,000 venues, and concluded that 1 in 5 of those bosses was not planning to ever open again some of the sites that they had shut because of lockdown. Other sectors will also be hit badly, with predictions, for example, that tourism and leisure will also continue to remain weak until even 2022. Will high street retail ever be the same again? And what will be the impact on commercial property as a result? Also of major concern at the moment in many sectors is the disruption to supply chain management, particularly from overseas, and the ongoing impact that this may have on their businesses. However, amongst this disruption, strong businesses are seeing opportunities across a variety of sectors, particularly technology, and within that, such examples as RegTech, regulatory technology, and MedTech, medical technology. Just as by way of an example, VoxSmart is a company that provides financial services clients with a platform to record the decisions, the conversations that lead to a decision to make a trade. Now, in the old days, that used to just be landlines. That then went into mobile phones as well. But with COVID and working from home and agile working, increasingly people are using different platforms. So they're using WhatsApp, they're using Zoom, Teams, and various other things. And for Voxmart, this proved to be a real boon. The demand for their product, which allows all of those different platforms, the information on those platforms to be brought together in a single line, a single timeline, leading through to a decision to make a trade, was heavily in demand, and their fundraising was well oversubscribed just recently. Interestingly though, a straw poll that was taken just before this webinar, it was surprising to see how many people felt private equity firms were still reluctant to invest. It's certainly not what we're seeing at the moment. That's not our experience. We now have private equity firms and family offices who are proactively looking for deals and emphasizing just how much money they have to invest. Only yesterday I received a call from one of those contacts letting me know that they just completed a fundraising for an additional £200 million fund, and they're now looking for homes for that. Such firms are looking not only for new deals, but also prepared to invest in existing portfolio companies that are looking to take advantage of new opportunities and or building volume through bolt-on acquisitions, which unfortunately may present themselves to you as a result of competitors not faring so well during this period. However, what I would emphasize is that whilst they are proactively seeking good quality opportunities with solid, experienced management, more than ever, because of the uncertainty COVID has created, they will be looking for reasons not to invest when talking to targets. It's therefore imperative that well thought through and presented pitch decks and business plans are prepared. These, again, using Caitlin's comment earlier about transparency, these should transparently set out the impact of COVID, both short and longer term. PE firms need and want to understand, and they want to see that management have recognized, understood, and reacted appropriately to the changing environment and are approaching current business plans and strategy in a cautious and conservative way. Whilst I've focused on private equity, let's not forget trade buyers and trade investors. They are similarly looking for bolt-ons, for opportunities to add value and add volume, and even to enter new markets. So they are there in the marketplace looking for deals at the moment. Just as a final thought, we should highlight that both financial and trade investors are looking for both UK domestic and cross-border opportunities. We've recently completed pre-acquisition due diligence on a UK-owned manufacturer, which had a subsidiary in Hong Kong as well as in the UK. We're currently discussing secondary buyout of a portfolio of Southeast Asian-based companies. And within Kreston International, our corporate finance special interest group has once again become active with cross-border opportunities, both UK inbound and outbound. And on that note, I'll just hand over now to Andy Wallis.
Thank you very much, Jack. So where will international trade be in 3 to 5 years? A lot will have changed. The Brexit transition period will have concluded. We may or may not have a free trade arrangement with the EU. We may have agreed bilateral relationships with other key trading partners, such as the US, or we may have found this too tough in the uncertain and volatile economic and political environment. I would therefore be a brave man to forecast where international trade would be in the next 3 to 5 years. Fortunately, I don't have to, as we collated the views of business leaders of SMEs across the UK in our Trading Internationally 2020, a post-COVID perspective survey. This survey is available on our website and is definitely worth a read. Whilst there were, of course, a range of views on certain topics, there were also a lot of common themes and trends that are worth highlighting. There are a few points that I particularly wanted to discuss. The first point to highlight was that 55% of businesses delayed or cancelled plans to export into new markets and trade overseas. Positively, however, over 80% of businesses surveyed expected international trade and export markets to return to pre-COVID levels within 3 years. This is great news, as there is no doubt that international markets matter to the success of the UK business and UK economy. We believe that there are opportunities for those firms looking internationally, and it is encouraging that our survey portrayed the same view. On similar lines, the second point highlighted by our survey was that over half of businesses thought that the importance of exporting goods and services has increased in a post-COVID-19 world. Given the size of the economic shock to the UK and world economy, being set up to export internationally can only be beneficial. Different sectors and countries will recover at different speeds, not least as a result of the continued threat of second spikes, which might force further lockdowns and restrictions.
Hi, Andy, I think you've muted yourself accidentally for the last 30 seconds.
Thank you very much, Jack. Not quite sure how that happened, but trials and tribulations of technology. I will go back about 30 seconds therefore, so apologies if I do miss anything. Of course, trading internationally comes with additional complexities. It wasn't a surprise that tax and VAT and duties were seen as the biggest barriers to international trade, followed closely by currency fluctuations, tariffs, and other red tape and administration. In a post-COVID-19 world, it is possible that there will be even more complexity as governments take further steps to support their economies, and in particular, implement tax changes as a response to the fiscal shock. And there may, of course, be challenges for supply chains as shipping routes and warehousing could all be disrupted by local lockdowns, etc. What is clear is that those businesses who are nimble, plan ahead, and are well advised are the ones that will be most successful in 3 to 5 years. Our survey has shown that looking ahead 3 to 5 years from now, international trade will be more important to UK businesses, and hopefully many businesses will find that it has been the route to their recovery, and they have a more resilient business following on from the COVID-19 economic shock. So what should you be doing? In the first instance, companies should be dusting off their short-term Brexit plans. I'm sorry, I have to mention it when talking about international trade. Many of the plans and steps to manage impacts may no longer be possible. For example, stockpiling was a key mitigation strategy for a lot of companies. However, it may no longer be a possibility for some with increased working capital pressures. Whilst there is still some time, these Brexit plans need to be reassessed to ensure they are still fit for purpose, and importantly, they need to be implemented as time is ticking. Just as importantly, however, companies should also be looking out further beyond Brexit and thinking strategically about the international opportunities that are available to them in the medium term. A good starting point would be for companies to critically evaluate their operating structure. Does this give them the flexibility required? There will be many different competing factors to consider both on the demand and supply sides of the business. For example, on the sales side, companies will need to assess whether they should be selling internationally from the UK, whether they should have an overseas branch or an overseas subsidiary, and what would the tax implications of each be? What are the implications of employing sales agents overseas? On the supply side, they will need to consider the resilience of their international supply chain and assess whether this needs to be restructured. For example, there may be a need for more local production. Companies should also think about the barriers that are stopping them from trading internationally and what they can do now to overcome these. For example, currency fluctuations were highlighted as a concern. Companies could design their approach to foreign exchange management and document their hedging policy now so that stakeholders know the steps to take in the event of currency appreciation or devaluation. Another example could be to develop a checklist of matters to consider when expanding into a new territory, covering whether on a general or specific basis, things such as tax registration thresholds, potential employment law considerations, or understanding whether local directors are required when incorporating a local subsidiary. There is much complexity to think through, and thinking about it now is the best approach. In conclusion, international trade is important, and will potentially be even more important in 3 to 5 years. Over a third of businesses in our survey set out that they believe that they are likely or very likely to expand internationally over the next 3 years. In order to make the most of the international opportunities, companies should look ahead but plan now. Those businesses that have undertaken scenario planning, developed strategies and policies now, will be the businesses that can be agile in the future and maximize their opportunities as a result. Thank you very much. I'll hand back to Andrew now, who's going to manage the Q&A.
All that's can.
Yeah.
Excellent, and thank you very much to each of our 4 presenters. Some very useful and insightful information, hopefully, to many of you. And hopefully you can all see that they've come back to join me for the next session. But before we go on to Q&A, I just wanted to summarise what I heard as the top 5 takeaways from each of them. Firstly, keeping it simple but informed. I think all of us are used to receiving management information for our businesses, but is this the right information you need to help make the decisions going forward? And do we need to reflect on, do we need different information or additional information? As Andy was just saying, dust off your Brexit plans. I too am going to have to use that word, but again, with the international nature of this webinar, it's really important to reach out further and think strategically about the international opportunities available to you in the medium term. Planning ahead, we've heard international trade will continue to grow and become increasingly important over the next 3 to 5 years. So be opportunistic and start planning now. We've already heard that those businesses that may have slightly shelved that over the last few months are definitely looking at it on the horizon. And again, review business plans. We heard that funding is clearly available for the right opportunities, but it needs to have the right management behind it as well. So more than ever, please make sure your business plans fully address the lenders and investors' concerns from the outset. And again, at the beginning, going back to Caitlin, thoroughly scrutinise your cash flow now. It reminded me of a conversation actually I had with a business shortly before this webinar, where they were talking about how well they'd done through COVID and how wonderful things were going. And then after about the first 15-20 minutes, they said, cash flow is a bit of an issue. And we've all been there before, and we've all seen that. So please don't get fooled. But anyway, so those are what I see as the 5 key takeaways. What I'd now do is like to open up questions to the panel. And hopefully you've all received instructions on how to ask a question. In fact, I know you have, because they've been coming through, thank you, as the panelists have been talking. So please do continue to share these as we go through. But I'm going to start off with the first question, if I may. And actually, the first question is, are we seeing any evidence of mainstream banks tightening their lending criteria? Emma, could you possibly comment on that one?
I think at the moment there's still very much an emphasis on the government-backed schemes, and there's a bit of uncertainty about what the banks might be offering once they're over. But I imagine that we're likely to see things like more security being asked for than we might have seen before. But it's never changing thing at the moment. But it is reassuring to see that some banks are starting to open up for new business, because that was something that wasn't a thing not that long ago.
Andrew, if I can add to that as well,
Yes, please do.
It's very clear that the banks are very concerned about the impacts and the uncertainty around COVID. So they've always done due diligence themselves, the pre-loan reviews. They're going to continue to do those. And that comes back to this whole issue of transparency and being able to demonstrate to the banks that you have really taken into account the impacts on your business of the whole COVID environment and your recovery stream from there. And if the banks can be satisfied that you've done your homework and you've got sufficient safeguards in place, and that the opportunity is a sensible opportunity going forward, then yes, we are led to believe the banks are now prepared to look at those things Tightening criteria, security, yes, but it's more going to be, in my mind, it's going to be more about whether that project is a sensible project in the current environment.
Caitlin and Andy, do you want to add any more to the comments from Emma and Jack? If not, I will move on. And Andy, I'm going to come to you next, I think. Interesting technical question. Brexit, and you mentioned Brexit, so very topical for you. Rules of origin, how important are these?
Oh, crikey. So this isn't my area of specialist, and I think this leads nicely to a point which you know, I made about companies being well advised. It is important to get specialist input, but my understanding is that the rules of origin will be very important post Brexit. Even if we have a free trade arrangement with the EU, in order to trade tariff-free, then it will be necessary for companies exporting out of the UK to the EU to be able to prove the origin of goods going into the UK, or vice versa for goods entering the UK from the EU. And just to sort of summarise, the rules of origin are there to stop companies sending goods via a third country to avoid duty.
Lovely, thank you. Assuming there are no other comments on that one, another question that's come through is actually in the construction and property sector, actually, a redevelopment project with a potential corporate tenant. We're looking at a long-term lease here, so with you know, future income, I'm going to say almost guaranteed. What's the appetite going to be about that?
If I jump in, yeah, Andrew, you already mentioned the importance of the corporate tenant. I think the fact that there is a tenant that's already lined up, and I assume is perhaps at heads of term stage to say that yes, they will take that property once it's developed, that will make a big difference. But we are still seeing both financial institutions, but also a number of these family offices who are keen to take advantage of either property development or property refurbishment projects. And again, it comes down to the devil in the detail. Just what is the project? Where is it? What's the end goal? Are there going to be tenants that are already lined up to take them or not? But there is definitely an appetite there in the marketplace for property development deals at the moment.
Perhaps Emma, you might be able to add to that a little bit. I mean, are you seeing from the sectors that are having loans approved a greater appetite in the construction sector? Or is it, as Jack's saying, that having, I suppose, a guaranteed future income stream, perhaps an indication of where lenders are looking more for greater security?
Yeah, I think that having that security is obviously something that's going to be quite attractive to lenders, and we are starting to see a few more property-based funding applications kind of going through. So I think it's probably something that's might be starting to become a bit more popular sort of towards the back end of this year, because obviously I think we're starting to see some commercial properties or some owners of commercial properties looking at their options, and it might be that they're looking to renegotiate or to potentially sell their properties. So it's something we're starting to see a bit more of.
I think it's also important, just to stress that it does depend on the nature of the property, because I mentioned earlier about retail high street and where's that going to be going in the future. And I think we're increasingly going to see landlords of retail outlets having to renegotiate, and you do question what's going to happen to the value of those properties. So as I said, devil's in the detail, and actually the nature of the property development you're talking about.
And Jack, if I may, can I ask the question that lots of people are asking at the moment around the future of the workforce in the office? And are you seeing anything in the commercial space, property space there for offices?
Yeah, I think it's a great question. And I think there are an awful lot of businesses that are currently reevaluating what their office and premises requirements actually are. With an increase in remote working, agile working from home. I think we're all reevaluating that at the moment, and I would suggest that is going to have an impact on commercial property as well. but there still seems to be an appetite for commercial development. There is no two ways about it.
I think that's interesting. I don't know what other people think, but I'm increasingly seeing, particularly in cities, people downsizing in terms of office space. I was reassured listening to the radio this morning about one of the major law firms that's taken 40,000 square foot in one of the major cities in the UK, still saying it's going to be useful, because whilst it may not be for the original purposes, there is a huge need for people to come together, not just to get together, but for their learning and development skills as well. I don't know if any other panelists have any comments on that.
I read something recently that was looking at the impact of people working from home, and it actually said that if you're in something that's a creative space, or even with us accountants, we can have our creative moments, believe it or not, where we have to sort of think about things outside of the box, and actually doing that face to face, you end up getting a much better collaboration. So I thought that was really interesting, because obviously we've all coped with Zooms and webinars and all that kind of jazz over the last few months, and I know that there's an element of probably a bit of fatigue in sitting in front of your screen, but it works, and then you weigh up the work-life balance that you're getting as a payoff for that. But actually potentially it might depend on the kind of area that you're looking to develop, as to whether that should be a face-to-face or a Zoom type affair.
Thank you, Emma. And interestingly enough, we've had one of the people on the webinar message in, basically saying to postpone any new office relocation until there is more certainty as to what is exactly required. And I mean, obviously that is a big question. We don't know. But clearly, and I heard yesterday from a lawyer, and no one would want to sort of be signing long-term leases at the moment, and I mean long-term 10 or 15-year leases, because of that uncertainty. And it's good to hear again from one of the audience that advice still holds. Good. If I then can move on to another question, and thank you for continuing to send them through. Please do so. Again, it's back to funding, and again, probably not an untypical question, and I think probably one that warrants a more specific answer after this webinar. But just generally, people wanting to start in new businesses, and I think that a lot of that will happen coming out of COVID-19. But clearly, people doing their business plans and projections, and as an example here, where, for example, sales have been delayed because of COVID-19 for a new business venture. Not an uncommon theme, but they're struggling to get finance for that. Emma, have you any experience of that from what you have seen of new businesses?
Yeah, I think it goes back to what Caitlin was touching on in terms of looking ahead and having up-to-date management information. That's really important. And like Caitlin said, actually, it's not the stuff that you had at the start of the year. It's revisiting that and making sure it's as up-to-date as possible. And I think that banks are open to lending. They just would like sort of evidence as to why certain things have happened. So, but obviously, not having that track record makes things a little bit harder. That's why it's really important to evidence as much as possible your future projections, and have as much backing documentation as you can with that.
So the message I'm hearing there is that having had future sales revenue or sales revenue deferred because of COVID-19 isn't helpful, but it's not necessarily a showstopper to raising finance if there are the right and valid explanations.
Yeah.
Is that right, Caitlin? Do you want to comment further on that at all?
Yeah, I mean, I was just going to, I guess, pick up a bit more on that, just as I'm saying. The banks do take a lot of comfort for having the right information presented to them in the right format, which is evidence-backed. If you have a chat to an advisor as well, they can go through and point out where you might need to flesh it out a bit more, where you need to provide a bit more of an explanation in terms of what has gone wrong. So for me, normally working in my restructuring space, we do quite often have help clients and have conversations with bank, and they take a lot of comfort from the fact that we're there. We've looked over the cash flows. We're confident that, I mean, at the moment it's hard. You can't say definitely that this is absolutely what's going to happen because no one really knows, but it's been looked over by a professional, and they're feeling confident, and I think the banks do take a lot of comfort from that as well. Yeah.
Perhaps just another thought from myself from a tax perspective. I mean, obviously it's important for companies to be looking for external finance, but I think companies should also think about looking a bit closer to home and sort of understanding their position, their profit forecasts, whether they've got expected losses that they might be able to carry back to prior years, and just thinking about the timing of their tax payments as well. Just a sort of small aside, but do think about the detail in your own business rather than always looking externally.
I'll just say one more thing as well. Don't just focus on the banks. I sort of picked up a little bit in what I was talking about, but quite a few of the local councils do have zero interest loans, and some of those are a bit more aimed at startups, etc. So they don't necessarily need all the evidence that a bank will. So it's just something to keep in mind if you are struggling to find it with the traditional lenders.
I think one other key point though, Andrew, is is it deferred or is it actually lost? So if unfortunately because of COVID you've lost sales and you are never going to recover those, and it's delayed the whole process of building up that sales pipeline, that will become an issue that whether it's private equity or debt they will be concerned about. But if you can demonstrate that those are contracts that have just been delayed, postponed, deferred, you've got contracts in place, you've got even expressions of interest, letter of interest, then that obviously gives you a bit more ammunition to be able to prove to them that this is just a delay, it's not long term.
Fantastic. So some really helpful comments there. Thank you all. I'm now going to just sort of develop a bit more of an international theme with the next sort of questions. So I've been trying to sort of group them. Interested in the panel's view on what's happened in Germany with their extension of their CJRS scheme to 24 months. And as was mentioned earlier, our schemes are coming to a close in the next couple of months. Any views about what people may think may happen in the UK in terms of future funding? Will we follow Germany? Will we do something different? Anybody want to kick off? A tricky question, I know.
It's a very tricky question, and I'll sort of slightly sidestep it by saying I think it really does come down to the future sort of fiscal position of economies and countries going forward. And I think it'll be interesting to see how tax initiatives develop, because at some points all of the support that is being extended will need to be paid for. And so I think there will be a big sort of difference in the approach that different countries take, whether that will be using the tax system to incentivize certain sectors or certain businesses. In the UK, we're lucky to have a very, very generous R&D scheme, or whether it will be, if countries invest more through schemes like the CJRS, then the natural assumption would be at some point that could well lead to an increase in corporate tax rates or income tax rates in order to pay for that. So it's that fine balancing act between supporting the economy now, but bearing in mind you want to have an attractive sort of tax system in the future, and not hiking your rates up to pay for it later on.
And any other comments?
It was a tough question, Andrew.
Sorry. Well, we have a good audience. Let me just then move on, and I'm going to pick up on a couple of earlier points that have also come through. Growth strategies. So again, we talked a lot earlier about looking forward 2 to 3 years. I also mentioned at the beginning about how different industries, I think, will look at international and globalization differently going forward. We've seen some comments back from our survey, which shows that people will focus on international strategies more. Do you think there are particular sectors or organizations that should be perhaps revisiting their business development and marketing strategies and expenditure? Are they missing out on opportunities? Should they be be looking elsewhere internationally? Are there going to be potentially be more favoured countries to go to if, for example, they do have more favourable funding facilities going forward than we have in the UK? Anybody want to pick up on that to begin with?
Yeah, I'll kick off on that. It's I think every business really ought to be re-examining the strategies, the growth strategies they have. This is a point to just do a sense check and say, given what's now happened, what's changed in our business model, our revenue model, where are the opportunities for us? Because even if you're looking at it in terms of your own cost base, I've mentioned supply chain management is of major interest to most businesses nowadays, particularly where those supply chains are coming from overseas. So can you as a company change that supply chain? Can you maybe even acquire a business that you bring into your group to guarantee a supply chain? That's just one thought. But I do think that everybody ought to be looking again at their marketplace. There are no doubt that there are some businesses that are not going to continue as they were, but equally there are new businesses that are coming through in this new environment, in this new era, which people can develop, and that may be with an overseas element to it as well.
And perhaps if I sort of pick up on that from a tax and transfer pricing perspective, I think a lot of businesses will be looking at their operating structures and their business models, and I think it's always something that those international businesses need to think about in terms of making sure that transactions are happening on arm's length, and that the functional analysis of their businesses and the way they're operating continues to fall within their pre-existing transfer pricing policies, or whether new policies need to be put in place.
Great, thank you all. I think we have time for one final question. And we heard earlier that cash is king. We're in a world and an economy of low interest rates where people have been building up debt over recent years. How do you see the balance moving forward between cash being king and borrowing? Oh, stony silence from the panelists.
I think cash is king will always be there. Caitlin was absolutely right, but it will always be there. I think at the moment, because of the uncertainty, nobody likes that uncertainty. So to protect against it, I would expect businesses to build that cash reserve, not to gear up too heavily, because the last thing you want is for a change in government policy on interest rates, which at the moment we haven't talked about, but at the moment those interest rates look as though they're going to stay relatively low for a reasonable period of time, although I did read an article which says that inflation has gone up in July for the first time in 4 months. So we're not going to go into negative interest rates, which I know we talked about at one stage, but hopefully they will stay low for a while. But even so, you don't want to be building a huge amount of debt in a business now, and then 6 months, 12 months further down the track, you then begin to hit problems because you can no longer actually deal with that in your own cash flow.
And I think this is a good reason to revisit what your growth plans look like, and actually perhaps look back over everything, and just take a step back, because it might be that you're trying to put so much effort and funding into one area of your business, when actually there could be a completely different avenue you can go down that doesn't need so much debt involved in it. And I think it's quite easy just to get bogged down in the day-to-day. So I think it's also useful to look at where your leadership is spending their time, and whether they're actually enabling themselves to have that looking ahead time, rather than kind of getting bogged down in the management day-to-day stuff, if they have that flexibility.
Great. Thank you, panelists, all very, very much for answering the questions, and thank you, audience, for all the questions that you've posed our panelists. I know one or two of them caught people out unawares, but if you do have any further questions on any of the topics covered today, or for your business generally, there will be a short survey available once this webinar has ended, via email, and obviously you can share any points you have from there. Clearly, we'd be happy to discuss any of the points. I have deliberately kept the questions anonymous, as I appreciate some of them were quite personal to individual people. If I can just sort of end by mentioning our next webinar, the 5th one, which will be on looking ahead to the future with purpose, and the importance of purpose, reviewing that together with your sustainability and corporate and social responsibility. I think this is a particularly exciting seminar, actually, because typically business have 4 generations of people within the organisations: baby boomers, Generation X, millennials and Zers. And it's really important for organisations to work out what they need to do to ensure all 4 generations feel they belong to it, and what businesses stand for. And it's been proven that those businesses which actually have a strong purpose actually have a much greater chance of growing than other companies. But anyway, I'll wait for that to happen in the next webinar and leave you till then. Thank you all. Bye-bye.